Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner, with the first of two September monthly market updates. We'll do one now and then one after the Fed decision next week. We hope this note finds you and your families well. Before we begin, I want to thank our clients for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. So we'll jump right in. First, an announcement. We want to congratulate Advisory Associate Henry Keltler, who has now been with us for 4 years. Started us during the pandemic, September of 2020, 4 years of serving our amazing clients. We also hope to see many of you at our October quarterly investment forum. You should receive invitations about that soon. Hope you'll attend and bring a guest, and we'll unpack all of these things in a lot more detail. So some market themes that we're following this month. First is the Fed cutting rates. That'll start as early as next week. A slowing but not yet stalling economy and earnings growth that is broadening out at least a little bit. So the Fed cuts rates likely next week. There's almost a certain chance of either 2/3 probability of 25 basis points and a growing chance of even 50. So likely the Fed will cut by 25 basis points next week based on where the Fed funds futures are at present. So if you look at different asset classes after 12 months after the first rate cut, you'll see they're pretty supportive of stocks and bonds. Treasuries, that's understandable that they would benefit by rates that are going down, but growth stocks as well. So generally speaking, after the Fed starts cutting rates, it's supportive of both equity and bond assets. The economy is slowing, but not yet stalling. The most recent read Q2 is 2.8 annualized, 1.5 is what's expected the last 2 quarters of the year. So while this is definitely slowing growth, it's still positive. That's what's expected. Some signs of weakness, though, on the consumer. You'll see debt service ratio is picking up. This is the percentage of American households' income used to service debt. And also delinquencies are picking up. So this is auto and credit card. So the consumer, which drives 70% of the economy, is showing some signs of weakness. Also, earnings growth is broadening at least a little bit. Recently, we saw the S&P 500 less tech have positive earnings growth for the first time since 2022. However, this broadening is thus far only large cap. So we see broadening earnings beyond tech, but not yet into small caps. So the most recent jobs report was pretty lackluster. 142,000 jobs added. 4.2 is the unemployment rate. That connected to July, where we saw 114, but that was revised most recently down to 89. Shows a significantly weakening job picture. And we saw that recently. The big headline that many of you may have consumed is that the BLS overstated jobs by over 800,000 in the 12 months ending March of 2024. So job hiring and jobs are a sign of weakness over the last few months. CPI is 2.5 as the most recent read core, which excludes food and energy at 3.2. So inflation is still at a place which is supportive of the Fed cutting rates next week. We have seen a significant pickup in volatility from kind of late July through early August timeframe. From 716 to 85, you saw the S&P down 8 and technology down 14.5. And about the time you sold all your tech stocks down here, they rallied from 8.5 through the end of August, up 12.2. So a lot of volatility in that kind of late July, early August timeframe. In fact, we saw the VIX decline 58% over a 7-day period in early to mid-August, which is the biggest 7-day volatility crash in history. So a lot of kind of volatile markets, in that late July, early August timeframe. We also had an interesting news just over the last few days that the yield curve has uninverted for the first time in over 780 days since July of 22. And what that simply means is you're getting paid slightly more now for a 10-year bond versus a 2-year bond. And so that's an uninverting of the yield curve. We've been inverted since July of 22. So some reasons for pessimism. First of all, we do get the long anticipated recession. Again, the jobs picture is weakening. The consumer's a little stretched. So a reason for pessimism is that we do get the long anticipated recession. We get an inflation surprise, which affects the Fed cutting rates, geopolitical risk, U.S. debt levels. We now are just to service the debt. It's over $1 trillion, which is more than we're paying for defense. Earnings disappoint, and we're in an election year, which kind of just raised the things you can't plan for, what might happen, and the unexpected and the uncertain. On the optimistic side, that we do get a continued delay of the recession, so a soft landing is possible. Inflation remains supportive of the Fed cutting interest rates. We do get a widening out of market performance, which we're starting to see at least with the S&P 500 X Tech for the first time since 2022. Earnings continues to be supportive. An election year, regardless of the outcome, it's going to be over in a couple of months. So that's a sign of optimism where markets can adjust to consider what happens in November and how that impacts markets going forward. We will be rebalancing after the next Fed decision, so look for trade notes on that in the near future. None of this is kind of a replacement to contact us about how all of these things apply to you specifically. So if you have any questions, please do not hesitate to call us. We hope to see many of you at our forum again next month. Look for an invitation for that soon. And with that in mind, we'll close thanking you for the trust and confidence that you place in us, and tell you that we hope to see you on a Zoom call in person or at our forum next month. Until we see you again, be well and take care.